Somewhere near 6% level.
Well, very few people even at the Fed think that they're going to hike to 6%. The yield curve is going to remain inverted in my view, at least until the Federal Reserve cuts interest rates a number of times. And one of the reasons for that is, the market is of the belief that the Fed's going to basically be successful at some level, going to see lower inflation, going to see lower growth, and at some point they're going to stop hiking in the next 25 or 50 basis points. Once they do, the next move is going to be a cut, and the market's going to perpetually price for that. And because of that, you'll continue to see maybe a higher rate regime. Like, we're not going back to 1% 10-year yields, I don't think, but we could certainly see. Right. We're probably not going to see a 5% or a 6% 10-year.
You're warned, Ira Jersey. A question from Michael McKee as he looks at the data. Ira Jersey does yield. He's in the real world, unlike you.
He does. He does the real world. How much expectations for the Fed actually pushing around the curve on the short end? Are we seeing people react to the jobs report, or are they reacting to the idea of what the Fed may do with it?
Well, they're reacting to So whenever we get these data releases, so it's obviously the payrolls report is the granddaddy of them, and in fact, it actually the market reaction tends to be twice as large to any miss or beat than the next most important data release. Obviously, CPI next week will be an important factor as well. So it's basically the instantaneous adjustment of the market's expectations for what the data is going to do, where the economy is going to be, that ends up creating these knee-jerk reactions. Yeah. Initially we saw that massive rally in the front end in the 2-year yield, rallying 6-7 basis points. We then came off that after everyone, looked beyond the headline red headline number and listened to Mike McKee and saying, well, it's actually much more of a mixed report. It's not just a weak jobs report when you look at things like the wage data and some of the hours work data, as Mike noted earlier in the show.
Lindsay Piegza really emphasizing the wage data with the inflationary push there as well. Ira Jersey, thank you for the brief with Bloomberg Intelligence. For those of you with a terminal, he and his team, I'm sure, will be publishing into the afternoon on a new bond regime. Let me tell you about that right now, red and green on the screen. The VIX 15.33, the 2-year yield of 5.05. I'm going to go off where we were at peak. We're down 10 basis points off that, 4.95%. 10-year yield still above 4%. 30-year bond still above 4%. 2-10 spread, 92 basis points. We disinvert over the last 48 hours as well. And the tip was at 1.80 down to 1.75, now up to 1.78. I can't believe I'm doing all this micro adjustment on yield as well. Edward Harrison holds court for Bloomberg in Washington. He's with Bloomberg Markets Live, and we're thrilled he could join us now because he had to survive the most intimidating undergraduate prospect I know, which is Douglas Irwin on foreign trade and all American trade and our trade wars and trade economics. And ungodly had to sit through Blanchflower 101 up at Dartmouth. Ed Harrison joins us this morning from Bloomberg Markets. Ed, I look at the report, and I look at how you apply it into the real world of what to do at Bloomberg Markets. And I love your phrase, duration seekers. In your recent report on duration seekers, what are the yield hogs doing that desperately want to go out 42 years?
Yes, Tom, I think that the yield hogs are looking to pile into the longer end of the curve, thinking that now is as good a time as any to do that. And actually, up until this report, I would have said that was probably a little bit premature. But interestingly, this report confirmed some of the weakness that I had been seeing in the data. If you look at the rolling 12 and 6-month number of unemployed in the United States through the data back to 1948, what you see is that number actually declines to a low right before a recession, sometimes right at the beginning of a recession, but usually right before a recession. And what we've seen is that in April, we hit that number, that low. And the data that came out today confirmed that both May and June were higher on that rolling basis. And And so what that says is that maybe those yield hogs are correct, that now is the time to get into the long end of the curve.
I mean, Ed Harrison, what's so important to me here, and of course this is the heritage of our Washington News Bureau folks, Craig Torres, Rich Miller, and the rest of the thieves down there. And, you know, Ed, I look at what you guys do, and it's always history-based. What is your study of the if and when of how we disinvert? We have massive curve inversion, and I guess at some point that's going to go away. When we disinvert here from 105 beeps to 91 beeps right now, how does that happen?
Yeah, you know, that is a very good question, because we've had some bear steepening, and that's caused, say, for instance, a 3-month 10-year to disinvert 60 basis points. But I think Ira was right on the money when he talked about it's the cuts that are the real disinversion that we're considering. And the real question is whether that disinversion happens before or after the recession. You know, in the post-Greenspan era, the post-Volcker era, it's always happened before the recession. That is that we see a disinversion be up beyond zero, so that we have an upward sloping yield curve before the recession. But this could actually be a recession that's more akin to what we saw in 1980, where the Fed keeps it tight right up until the recession and even after the recession.
What are you going to write about today and into the weekend? I mean, you write such a curious piece for Markets Live. You never know what you're going to get from Harrison. What are you thinking about writing about 2-3 days forward?
I'm thinking about this as a confirmation that we actually have more weakness than we had thought. I mean, there's a lot of angst about is this cycle going to continue on? How much longer is it going to continue? Because everyone's been wrong about where the cycle has ended. But when I look at the data that came out today, it's more confirmation of the fact that this cycle is very late.
Ed Harrison, thank you so much for the brief. Really love it. You can see Ed Harrison, M Live, Market Live, and of course his work out at Terminal. So it's really eclectic stuff about how Ed Harrison out of Dartmouth and Columbia, how he applies all this econobabble over to, okay, what are we going to do about it, which is a little bit of applied economics and implied investment that has a value. I'm going to review this right now. Tell me here how I'm doing on time, guys, because I'm going to review this, and I want to be sure we try to get the whole story in. Futures tepidly weaker. S&P futures at -6, a VIX 15.46. In the yield space, it's just a jumble. I have a higher yield in the 10-year, 4.06%. 2-year comes back under 5 with some significant disinversion. The real yield back to 1.80%. What do you need to do? The acting U.S. Labor Secretary with Jonathan Ferro, Julie Su, in the next hour. Good morning. This is Bloomberg.
This was the first downside surprise on the payrolls report in more than a year. Live from New York City this morning. Good morning, good morning. With equity futures slightly negative, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Coming up, the U.S. jobs report coming in soft, with global yields nearing 15-year highs and the Fed on the brink of hiking once again. We begin with the big issue, payrolls in America.
You have to, pay attention to the data.
Payrolls,
Jobs data, labor market data.
Labor is the key.
Labor supply is going to be hugely important.
That employment picture is probably the linchpin that we're all looking for.
Labor market remains quite resilient.
Labor markets have to soften.
We really need to see the job market start to crack.
We haven't seen anything crack yet.
The stronger the data comes in, the more aggressive the Fed ultimately needs to be.
We're still worried that the Fed needs to do more.
They're taking everything into account.
They're going to have to continue to hike until they break labor.
The Fed has to break the labor market.
If the Fed is looking to loosen the labor market, we're just really not seeing that in the data.
The employment story is still very strong.
At the end of the day, this is going to be a big concern for the Fed.
What about that ADP report? Joining us now to discuss the payrolls report, Mohammed Al-Erin of Queen's College, Cambridge, and BlackRock's Rick Reeder. Gents, wonderful to catch up with both of you. Mohammed, first to you. Your response to that jobs report 31 minutes ago.
Good morning, John. 3 responses, from the specific to the general. One is, despite the miss on job creation, this will not get in the way of the Fed hiking in July. It will moderate expectations as to what happens thereafter. But with the wage growth, the labor force participation, and the unemployment rate, these 3 things means it will hike in July. 2 is the craziness we're seeing in the fixed income market, where the 2-year has been all over the place, and God bless Rick for navigating this market. The craziness we're seeing there highlights not just the regime change, but importantly, the lack of a policy anchor. And then the final thing is something that's not discussed often enough, is that if you look at the details of this jobs report, it indicates that it is the most vulnerable segments of the population that are at risk right now.
God bless Rick Reeder. Rick, what's your take?
I appreciate that a lot. Listen, I agree with everything Mohammed said. It's a solid report, though. I mean, yes, it was a little softer on the headline, that the wages were up, the work week was up. And, you're operating at 3.6% unemployment rate. We just had claims data that continues to show that labor's in good shape. JOLTS data was a little bit encouraging, and that private hiring was coming down a little bit. But, boy, you're still talking about a lot of jobs open. So, anyway, I think I think you got to parse it quite finely to say it's softer. I mean, it's solid. I mean, the economy is solid, and employment data is solid. And agree with Mohammed that, listen, the Fed's going to keep moving on the backside of this.
And to be clear, the bond market is of that opinion as well. Yields are climbing higher now by 2 basis points. We're back through 5% on a 2-year. Initially, off the back of the downside surprise on the headline number, yields were lower. They've popped back. You look through the rest of the report, Mohammed, to Rick's point, you've got the average hourly work week that's just a little bit longer, unemployment a little bit lower, wages coming in a little bit softer. Mohammed, where are you now? Which camp are you in on the FOMC? Are you of the opinion that there are long and variable lags to policy, there's enough in the pipeline? Or if you were on the committee, would you be pushing for more to do, more hikes?
John, it depends what anchors this committee, and you've heard me say this over and over again. If this committee is anchored by we've got to get a 2%, whatever may, and central bank policy is the only tool being used, then they're going to have to hike at least a couple more times because they're highly data dependent. If, however, they step back and have a more strategic view of the economy and recognize that we have issues on the supply side and that crushing demand to address supply issues isn't the right thing at this stage, but it means accepting a much lower trajectory or decline in the inflation rate, they would hike once and stop. But the problem, and you've heard me say this, is that when you're excessively data dependent, you'll swing all over the place. And with that, markets will swing all over the place, and then the risk of something breaking goes up.
Well, they have been in the bond market big time. Mike McKee's with us to break down this report. Mike McKee, the headline, disappointing, but beneath the surface, this is a mixed one.
It is a mixed one, but it might be, as we were talking about on surveillance a few minutes ago, a turning point. 209,000 jobs is still a very strong report, so it's not like we've fallen off a cliff here and we're well ahead of the number of jobs we need created to absorb new entrants into the labor force. And as you guys were just talking about, we're at a 3.6% unemployment rate. Hours worked went up, and average hourly earnings unchanged on the month after being revised up for May. So you have some strength in this report, but it does raise the possibility maybe that we are now slowing down to a sustainable level, and it will keep the idea of a soft landing in play. You take a look at where the jobs were and weren't. We knew housing has been very strong, new home construction very strong, construction up by 23,000, government up by 60,000. There could be a seasonal component to that, and that is probably not going to continue. And then you look at retail. Are we seeing a slowdown in retail sales? We've seen a bit of one, and so is this a precursor to what's going on? And then everybody likes to look at temporary help because that's usually seen as a sign of what's going to happen going forward with the labor market. And I'm going to switch gears and go to inflation because that's the big number next week. This is the Cleveland Fed CPI nowcast. And as you can see, it tracks pretty well with what's happening on CPI, and it does see a big drop next week to a little over 3.5%, which would be a sign to the Fed that they are making progress. The interesting debate is going to be how much of an impact wages are having. Profits have fallen off, and there was all the talk about greedflation, but wages are still high. So are wages creating inflation? That's going to be the question for the Fed, and of course they're arguing maybe not.
Mike McKee, thank you, sir. Rick Reader, let's get into it. Payroll's behind us, CPI in front of us. We've had a disappointing read of the headline number. We've talked about the nuances around that. The rest of it's pretty solid. CPI next week, what would need to happen to stop the Fed from hiking in July?
I think it's going to be pretty hard to stop the Fed from hiking. I mean, we think it's going to be a softer number. I mean, some of the high exogenous influence you've had from used cars, shelter, shelter comes down with a lag. We think that is going to come down, and we think you'll get a softer number. I think the markets anticipate that already. But I think it'll be pretty hard unless the number was extremely soft, which is hard to believe. Listen, the Fed is, and I think you got to take them at their word. They paused. We could debate was it effective to pause or not. But boy, it would be pretty difficult given all this labor data we got that we've just received. It'd be pretty hard to take the Fed off the mission, at least for this meeting. We could debate future meetings.
Well, Mohammed, let's talk about future meetings. This is what Andrew Hollenhorst, the city, had to say this morning. Risks are rising. The Fed will once again need to deliver a more hawkish message, perhaps at Jackson Hole in late August and/or the September FOMC meeting. Mohammed, I think for a lot of us, we're less interested in July, maybe even less interested in what September might bring. It's really about whether they need to go much further than that. Never mind 25 to 50 basis points. Do you have an opinion on that yet?
So that's where the disagreement is, John. I think most people expect they will hike in July. There's one or two outliers, but for the reasons that Rick just said, they will hike in July. And this is despite, I want to stress, I also expect next week's CPI number to be quite soft. We may get very low in the threes, but look at core. Core is going to be critical because of the changing dynamics of inflation. The fact that inflation has now migrated and is well embedded in the service sector. That is the concern. As to what happens thereafter, inflation will prove sticky, core will prove sticky, and the Fed is going to have to choose. Can it live with a 3 to 4% inflation rate that is stable, or does it want to crush the economy to get to 2%? That's the choice that they're going to have to make later in the year. And that's why people are all over the place, because their expectations of the real economy is quite different. As you know, I've always thought a recession need not happen, that this economy is strong enough to avoid a recession. But a lot will depend on how the Fed plays it.
Well, to be clear, you've also suggested, Mohammed, and you've insinuated it there, that they'd have to tolerate higher inflation to make sure that recession doesn't happen. Is that still the case?
Yes, John. I don't think anybody can deny what's happening on the supply side. We're seeing significant deficiencies of aggregate supply. They're happening from the rewiring of supply chains. They're happening from the geopolitics. They're happening from the energy transition and the labor market itself. Labor force participation has been stuck, and we're not attracting more people into a hot labor market. So we have issues on the supply side, and this notion that we've got to crush demand, we've got to crush jobs to address a deficient supply side, for me, that's not good economics. We've got to address the supply side and make it more elastic.
Let's talk about a bond market that's been crushed as well. 10-year right now, 3-4%. 2-year right now, around 5%. Rick, as you look across that curve right now, what's a buy for you?
Like commercial paper. We're buying. I mean, it's pretty incredible. You can buy 6-month to 1-year commercial paper. We bought some this week at 6.6% yield. Good issuer. By the way, not a fly-by-night issuer. I mean, it's pretty attractive. I mean, if you can clip in CP, if you can clip sixes, and you're seeing banks, you're seeing others that are and companies for working capital that are issuing there. That's pretty darn attractive. Listen, I think you still got to be a bit patient on the rest of the curve, and let it do what it's going to do. I mean, to take a lot of duration risk today doesn't strike me as an awful lot of sense.
We've got to tease some more out of you than that, Rick. Are you saying there's still upside risk on that 10-year right now?
I mean, I do. I mean, you look at, by the way, you operate in the bond markets in a global framework. The Bank of England is hiking, the ECB is hiking. And by the way, there's a lot of duration. There's a DVO1. There's a lot of duration that comes into those markets. The U.S. Treasury's got to issue a lot of debt. I mean, by the way, look at the amount of bills that are coming to market every week. It's not like we're running out of supply to purchase. So listen, I think rates can move a bit higher from here. Do you start wading into some places? Some of the credit markets I think are okay. The mortgage market I think is okay, and I think it'll perform reasonably well. But I don't think there's any race. I remember we were on a couple of months ago and we were talking about, and somebody was saying we're going into a recession. You got to get into that.
Sure.
I don't know. I don't think there's a race.
We were talking about credit crunches and banking failures only a few months ago.
Right.
And look at us now. Mohammed, the UK, end of September, Liz Truss is in number 10 Downing Street. We're talking about financial instability and bond buying, more QE potentially from the Bank of England, and rates then on a 2-year gilt yield, we're through 4.70. Right now, they're looking at 5.50. Mohammed, have we walked away from the financial instability of the last 12 months a little bit too quickly? Do we need to keep an eye on that?
We do, John. I mean, what's happening in the UK is the amplification of the inflation problems all over the advanced world. Inflation that is more sticky is higher, and the Bank of England's got to go do even more. Add to that the real economy is weak. So this is probably the most difficult policy challenge out there. And you have now the society is literally gripped by interest rate fever. Everybody's talking about mortgage rates. Everybody's talking about what's the Bank of England going to do. It's not limited to Bloomberg anymore. It's everywhere. So it's going to be really interesting as to what happens to sentiment. I think the main issue now, John, is that while we've navigated interest rate risk relatively well, notwithstanding what happened in March, but we've navigated as a whole relatively well. The big question is, do we also have to navigate credit risk? That is, I think, the big question. In the UK, the answer is more yes than anywhere else in the advanced world.
Rick, what's your response to that for the US?
I mean, listen, I think you got to be a bit careful about, as rates continue to move higher, I think you got to be a bit careful about the levered parts of the market, whether that's leveraged loans, whether obviously commercial real estate's been well established. We're going to have more pressure on the banking system. There is no question about it. You're going to continue to lift the cost of deposits. You can't build capital. So I think there's going to be, an increase of some stress in some places. But, you look at, there are also a lot of the investment grade markets termed out its debt. I mean, the housing market is, consumers have paid down their debt. So it's going to be bifurcated. But you're definitely going to have in the stress parts that are interest rate sensitive, there's definitely some credit stress that's going to continue to come.
We'll build on that in just a moment. Rick Mohammed, you're going to stick with us. Equities right now just a bit softer on the S&P 500, negative by 0.2% going into the opening bell. Coming up, President Biden promoting his economic agenda.
I'm not here to declare victory on the economy. I'm here to say we have a plan that's turning things around quickly, but we have a lot more work to do.
The latest from Washington, D.C. up next.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local to the local countries that they are operating in. So you need to be global and local at the same time.
The share of working-age Americans in the workforce is as high as it's been in 30 years. Remember they used to say, Biden spent all this money to keep people from working? People are off the sidelines. And folks, it's no accident. It's Bidenomics in action.
President Biden promoting the impact of his economic agenda, in particular highlighting the labour market, arguing it's the outcome of his legislative accomplishments as the June top line payrolls number comes in lower than expected. Bloomberg's Kelly Lyons joins us now with more. Hey, Kaylee.
Hey, John, lower than expected, and yet we still haven't gotten a statement out from the White House, but you could expect that they are still going to spin this in the positive direction, because at 209,000, that is still relatively robust payrolls growth and brings the total even further above 13 million jobs created since President Biden took office. This is something he has continually touted. Also, the unemployment rate as well. Just last night, the president was tweeting how unemployment has remained below 4% for the longest stretch in 50 years, so that ticked down to 3.6% evidenced in the data today, likely something the president is going to flag, as well as the stronger wage growth. The idea that Americans are seeing their wages moving up to compete with the higher costs that they are facing, though, of course, in recent weeks, the president has repeatedly been trying to push the message that he is assisting in getting inflation down through things like the Inflation Reduction Act, also touting things like infrastructure packages and the CHIPS Act, of course. The difficulty for this administration, John, and for this re-election campaign of President Biden is, despite an economy and a labor market that still is looking very tight and quite robust, it is not translating into his polling. A new Economist YouGov poll came out just yesterday that showed the president has just 42% approval on his handling of the economy, 52% disapprove. And actually, the average, according to Real Clear Politics polling over the course of the last month, is even lower than that at 38.7% approval. So if indeed the Fed, after looking at this data, hikes once again this month, tightens policy further, and we start to see that deterioration in the labor market taking shape later this year or into 2024, that's getting closer and closer to when voters are going to have to head to the polls and decide if they want to vote for this president again, John.
Kelly, thank you. The latest from Washington. We'll build on that with the acting Secretary of Labor, Julie Su, in about 20 minutes from now. Back with us for a final word, Mohammed Al-Arian. Rick Reeder, back with us now. Rick, you mentioned this about whether high interest rates are actually biting into this economy or not. Mohammed, Torsten Slock of Apollo wrote about this morning, why it's taken the Fed so long to slow the economy down. Pointed out a number of reasons. Here's three. High savings in the household sector post-COVID. Went on to say during the pandemic, high-yield investment-grade corporates extended the maturity of their loans. U.S. households have 30-year fixed mortgages. They're therefore less sensitive to Fed hikes. Mohammed, from your perspective, just how rate-sensitive is this U.S. economy?
So he's absolutely right. Initial conditions matter. And the initial conditions were such that we had strong household balance sheet and strong corporate balance sheets. So monetary policy hasn't hit. But John, we are the envy of the rest of the advanced world. I was sitting with a European politician yesterday, and he was complaining that foreign direct investment is going to the U.S., including European investment is going to the U.S. So we mustn't forget that this economy is, in relative term, outperforming many other economies. And therefore, when people live in relative space, as they do most of the time, they will come to the U.S.
Rick, does that shape your approach, your bias geographically in markets at the moment?
Yeah, by the way, I'll say one thing. I mean, you know, I think when people talk about the Fed just keep going, if you think about where we are, most people are sitting in mortgages that they locked in at 3%, 4%. So that's not interest rate sensitive. The companies that are growing, healthcare and tech, are not big borrowers. What ends up happening is once you just keep raising interest rates, all you're doing is you're impacting the lower end of the income strata. In fact, people higher end, they're savers and they benefit from it, and the people that are actually hurt by it, I just don't feel like to raise interest rates. One man's opinion. Now, to your question, listen, I do think the U.S. is, particularly in equity space, the most attractive place. By the way, globally from a debt perspective, I actually think EM is interesting, although we've been talking about it for a few months now. It's had a pretty good run. But, the EM central banks got at hiking earlier, and you're seeing inflation coming down. I actually think EM is in LATAM, Mex, Brazil are actually interesting places to invest. But generally, I would say U.S. is interesting. The credit markets in Europe are the other place. So that I feel like you're getting paid for taking the risk, and we think the default paradigm will be reasonably low there. But so anyway, I would say that shapes it generally.
Well, you took us there. Let's sit on it. EM, Mohammed, that's your world, particularly with your work with Gramercy. What's the big one for you at the moment?
I think being highly selective. Rick mentioned a few places that are interesting. You've got to be highly selective, higher in quality overall, and then look for the overshoots. Look for a situation where the market goes too negative. There's certain cases right now that are trading at ridiculously low levels. But the bottom line for me is highly selective, highly differentiated, because there will be a lot of dispersion going forward.
I have to say, Rick and I want to be where you are, Mohammed. It looks very relaxing. Wooden cabins.
It is true.
No comment from this end.
Of course.
That is. Hopefully no screens on.
Thanks for being with us, Mohammed. We appreciate it. Rick Reader, to you as well, sir. Thank you on this Payrolls Friday. Just breaking down a really nuanced report, what it means for this Fed. For this Fed, it looks like a hike in July. But for a lot of us, it's what happens after that, further down the road. How do they set the stage for policy, to Mohammed's point, strategically, going forward from here beyond the September meeting? Equities right now, just a little softer going into the opening bell, about 8 minutes away. We're negative 0.2% on the S&P 500. In the bond market, yields initially much lower following the jobs report. Then they popped higher again. We're just south of 5% on a 2-year maturity. On a 10-year, we're still through 4%. Yields are higher by 4 basis points. Elsewhere in the FX market, the euro trying to gain some traction through 109, just sitting above that level at the moment at 109.09 on the euro against the US dollar. Coming up on this program, the morning calls, and later, more on that downside surprise in the payrolls report. We'll catch up with Victoria Fernandez and PGIM's Michael Collins. Looking forward to that conversation, and this one too. Judy Su, the acting Secretary of Labour, the White House response, the government's response, Washington's response to this labour market report of the last hour or so. From New York, this is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
It's a mixed payrolls report. It's nothing like ADP from 24 hours ago. 1 hour ago, we got the payrolls report. Headline number comes in a little bit softer. Unemployment, though, lower. Wages a bit hotter. Average working week a little bit longer. Equities a bit softer, down negative by 0.2% on the S&P, and the bond market yields were down. We're back up again. They're pretty steady now at the front end. The 2-year almost unchanged at about 4.97 after going through 5% just before the payrolls print a little bit earlier this morning. That's the price action. Let's get you some morning calls. First up, JP Morgan downgrading Commander to neutral, seeing limited upside as the next US election cycle approaches. Barclays upgrading Newmont Mining to overweight, highlighting the stock's attractive valuation and recent underperformance. And finally, Wolfe Research upgrading JP Morgan to outperform, saying shares deserve a premium given the bank's favourable loan mix. Their stock is up by 0.4%. Coming up, the US labour market softens in June. More on the latest payrolls report with Crossmark's Victoria Fernandez and PGIM's Mike Collins. That's next. Your opening bell just around the corner.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Seconds away from the opening bell this morning. Good morning to you all. Couple of days of losses on the S&P. No big drama, but the S&P 500 yesterday, biggest one-day drop going back to late May, incidentally. Right now, futures softer by 0.2% on the S&P, on the Nasdaq down by 0.1%. All of this following a downside surprise on the payrolls report about an hour ago. There's your opening bell. Switch to the board and get to the bond market. This is what the bond market looks like now. Yields higher, initially lower. We're up by 3, through 4% in the last 24 hours. First close above 4% on a 10-year post the collapse of SVB. left behind that very quickly, didn't we? Let's see if that comes back on the table anytime soon. In the FX market, the euro reclaimed 109.09 on that currency pair. The euro against the dollar positive by 0.2%, and crude lower, down negative by 0.4%. $71.50. About 25 seconds into this session, here's the broader market for you. We're down, lower by 0.3% on the S&P, just a bit softer on the Nasdaq. One stock to watch at the open is Meta. Twitter said to be threatening legal action following the launch of Threads. In a letter to Mark Zuckerberg posted by Semaphore, Twitter's attorney writing, Twitter demands that Meta take immediate steps to stop using any Twitter trade secrets or other highly confidential information. Abby has more. Hey, Abby.
Hey, John. Yeah, never a dull day here for big tech. And of course, in this case, it has to do with Tesla and Twitter's Elon Musk versus Mark Zuckerberg of Meta, Instagram, and now Threads. And it's Threads that's at question. On Wednesday, when the app first launched, 2 million users within 2 hours, then 5 million, 10 million, 30 million. So yesterday, Twitter sent that letter to Meta. Alex Spiro, Twitter's lawyer, known as being super aggressive, basically said that Meta has hired dozens of former Twitter employees who may have access to confidential information. They're threatening that trade secrets lawsuit, saying that they will strictly enforce its intellectual property rights. It's highly confidential information. It's very difficult for this sort of a plaintiff to succeed. Ultimately, they may actually be looking for an injunction, which would also be difficult. Another question would be, because Meta responded saying that Twitter engineers are not on the Threads engineering team, would they have to prove that there's some sort of Chinese wall? So many unknowns. What we do know, John, on the day we have Meta up slightly, Twitter's up a bit more. Tesla, the proxy for Elon Musk, up 1.4% on the year. Tesla up 125%. Meta up 143%. Probably the early stages of the fight, but again, they will probably be looking for either an injunction or some sort of monetary damages. But how do you calculate the future and what it could mean? Stay tuned.
Abby, thank you. You mentioned Tesla. Let's turn to Elon Musk's other company in the news as well, providing fresh incentives for potential buyers in China. Running the following. Buyers will get 3,500 yuan in cash and a 90-day free trial of enhanced autopilot if they make the purchase via referral from another Tesla customer and take delivery within a certain period. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, John. Tesla is up 1.3%. Several pieces of news. The near-term driver of the stock is news crossing the Bloomberg terminal in the last 20 minutes that Mercedes-Benz is joining Tesla's charging standard here in North America. From 2024, Mercedes-Benz customers will have access to the supercharger network via an adapter, and Mercedes, like many others in its industry, later offering an engineering fix or production fix to match that standard while also building out their own network. The piece that Bloomberg reported overnight, in addition to what you said on China incentives, is that Tesla has started making some workforce reductions on the battery team in Shanghai, according to sources. There are 20,000 people that work in that Shanghai plant. What we're talking about is individuals on the team that take the cells from third-party suppliers and assemble them into modules and packs. One source told us that an element of this is because there is an aspect of automation that can replace some of those jobs. But this comes at a time where we are talking quite a lot about the price war, quote unquote, in China and the compromise that was reached in the last 24 hours. The third piece of news very quickly, Mizuho raising its price target on the stock to $300 from $230, maintaining a buy rating. If you're a Bloomberg Terminal user, go on ANR and just take a look on the top right-hand corner of the screen. The average 12-month analyst price target is 222.55. Tesla trading at 279 currently, and you'll see that since the news flow around other automakers joining the NACS standard, charging standard, that's where the stock's really taken off. But it's taken time for the sell side to catch up in that respect. We're now kind of on an upward trajectory in terms of how the sell side see this stock going currently, John.
Ed, you made 3 points. Let's pick up on the second one. Just the cuts of workers in China. Can you build on that a little bit more? Can we read into anything about demand potentially in that country, given where deliveries came in so well in the last few months?
The use of price cuts as a lever based on the latest quarterly production and delivery data indicates that did work in a market like China, where there are many more domestic players offering a wider range of battery electric models. BYD is a great example, right? Where in that country, they also sold more than 300,000 battery electric units. And if you extend that to plug-in hybrids, more than 700,000. What I've learned in speaking to sources is that it is normal in all of Tesla's facilities for them to review the structure of the organization and just make logical changes, trim teams or reallocate headcount. And we did report, according to sources, that those battery module assembly members that the jobs were removed were offered, in some cases, chances to move to other teams in the facility. And again, 20,000 people work in Shanghai, John, for Tesla, and that plant accounts for more than half of output last year. So it's kind of shuffling the deck, but it is worth tracking the minutiae of what's going on there.
Stock is up about 1%. Ed, thank you. The latest on Tesla there and Elon Musk. I want to turn to the financials going into earnings next week. Wolf Research upgrading JP Morgan to outperform, downgrading Wells Fargo to peer perform. Wells Fargo management has executed well, but shares have outperformed and valuation has converged with peers, while our JP Morgan upgrade is far from contrarian. We believe guidance will prove conservative. Shonali Basak back with us for more. Hey, Shonali.
Good morning, John. You're taking a look at Wolf Research. Look at two of the banks that are trading better than any of the banks in the system as far as the top six goes. Listen, when you take a look at Wells Fargo, Wolf Research's move here goes against the grain. 70% of analysts still say buy Wells Fargo. But what they're looking at here are the risks on the horizon, commercial real estate risk, regulatory risks. The reason the timing here is interesting also, John, is because you have Wells Fargo and JP Morgan are two of the banks that raise their dividend among the most of the big banks as well. So they're giving something back to shareholders. They are performing, but with Wells Fargo trading at about book value, you have Wolf Research now telling you maybe book value is just enough. JP Morgan's case is the bull case, and JP Morgan's case applies to other banks as well here, John. It's the idea here that capital markets, not necessarily all investment banking and trading, but the return of capital markets, IPOs, debt underwriting, will help banks like JP Morgan and Bank of America moving forward. That is the money case of the second half, according to Wolf Research.
Shonali, leading our coverage starting in about a week from now. You get some rest this weekend. Shonali, thank you. Looking ahead to JP Morgan results next week. Before we get there, of course, the CPI report. Behind us already today, earlier this morning, the payrolls report. Stocks wavering. Treasury yields near 2023 highs after a cooler than expected payrolls report at the headline. Mohammed Al-Arian weighing in earlier in the program.
Despite the miss on job creation, this will not get in the way of the Fed hiking in July. It will moderate expectations as to what happens thereafter. But with the wage growth, the labor force participation, and the unemployment rate, these three things means it will hike in July.
Two of the best on this. Let's get straight to it. Crossmarks, Victoria Fernandez, PGIM's Mike Collins. Mike, first to you, buddy. Your thoughts on that payrolls report an hour ago?
Yeah, Jonathan, I think it's a really simple message consistent with our view that economic growth is moderating. Labor force growth or labor growth is moderating. Wage growth is moderating, but it seems to be stuck kind of in the 4+% area, which is a little problematic. That's probably 50 to 100 basis points higher than the Fed wants to see wage growth. The breadth of labor market is waning, right? You're seeing the gains really in a few sectors now, which is kind of a leading indicator of maybe weakness ahead. But there's not enough leverage in the system for a big hard landing, right? So you're going to see a moderation in growth, a moderation in inflation. The Fed is going to hike in 3 weeks from now, 19 days from now. I think that's a done deal, but the threat of a hard landing is really low here.
Is it a done deal, Victoria, from your perspective?
Yeah, I think that at the July meeting, we're definitely going to get a hike at that point. You've just heard some of the hawkish talk from the Fed, even just from the last meeting, talking about the expectations of at least 2 hikes. And so I think given July and the jobs report that we've seen, I think it is a given. The labor market is key for them because it has the average hourly earnings, and labor cost is what's keeping inflation along with rents, but it's what's keeping it sticky right now. So they're trying to figure out how can they bring those labor costs down. You have average hourly earnings up 4.4% year over year. As Mike's used the word stuck for that, then I think that's a way that the Fed is looking at it. They're stuck right now, and what can
they do to improve it? Because look at some of the other elements of the labor market, Jonathan. You've got quit rates that were up in the JOLTS report yesterday. You've got longer-term averages that are coming down. Continuing claims were at a 5-month low.
Yeah.
So you've got elements that are telling you this is still strong and the Fed has more to do.
The work week lengthened. So let's talk about what we've got in this bond market now. 2-year just south of 5%, 4.93. 10-year at the moment just north of 4%. Mike Collins, how active have you been this week? Is that a buy on a 10-year at 4%?
Yeah, we, as you know, Jonathan, have been short duration here for a couple of months, really since the dust settled on the regional banking crisis, mostly in the belly of the curve, so long kind of cash and a little bit long the very back end, but that whole intermediate part of the curve is again pricing in still probably too many aggressive rate cuts too soon. So we've been short that. But with this big backup in rates, as you mentioned, I mean, the 5-year is up 100 basis points really in a couple of months. 5-year real rates are up 100 basis points. The numbers here, that 4 handle on 10-year treasuries is starting to get more appealing. We believe we're going to be in a range, say 3.25 to 4.25 on the 10-year. As you get toward that higher end of the range, you have to cover that underweight, and we've been doing that. We've been reducing our underweight really in duration.
Interesting. Mike, let's keep building on that. Mike Collins, Victoria Fernandez, they're going to stick with us. We'll work through this market. Price action, yields near 5% on a 2-year in the last 24 hours. We back away from that. Equities right now just a little bit negative. Coming up, a downside surprise in the payrolls report.
We are the envy of the rest of the advanced world. We mustn't forget that this economy is, in relative terms, outperforming many other economies.
Reaction down in Washington, up next.
July 11th, Bloomberg is live in Lithuania for the NATO Leaders Summit. Support for Ukraine, expanding partnerships, broad security challenges. We're bringing you news from the meetings and what they mean for the markets.
At the summit, we'll actually make important decisions to address our 2 main threats, Russia's aggressive actions and our efforts to fight terrorism.
It all starts July 11th. Bloomberg, your global business authority. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Live on Bloomberg TV and Radio, I'm Jonathan Ferro. Joining us now from Washington is Julie Su, the acting U.S. Secretary of Labor, responding to the labour market report from about an hour and 15 minutes ago. Secretary Su, fantastic to catch up with you. Just your first reaction to the payrolls report from earlier this morning, and whether we're seeing broad-based strength in this economy or something that's showing us things are slowing down.
Good morning, Jonathan. Thank you very much. This is a good jobs report. It represents steady and stable growth, which is what we want. It shows that the president's policies, Bidenomics, is working. It's combined with a 3.6% unemployment rate. Many predictions were that it would not get below 4% right after the pandemic-induced economic crisis for a long time, and these policies have defied that. And in fact, we've seen less than 4% unemployment for 17 consecutive months now, which is the longest duration since the 1960s.
We know we've got a bit of tension out there in the labour market at the moment, and you've been involved in some of that, so I want to build on some of it with you. We have a tentative agreement covering West Coast port workers. That's been an issue for a while. I know you've had some involvement, so congratulations for that. We now have a new issue, so let's talk about that one, the potential for 300,000 UPS workers to go on strike. How involved are you in those discussions with the union and UPS?
Yeah, thank you, Jonathan. Thanks for mentioning the port, because those parties worked very hard for over a year and did reach a tentative agreement recently. It still has to be ratified, so the process is not over, but it demonstrates that collective bargaining works and that you can reach agreements that are, as the president often says, good for workers, where companies can profit, and that's good for the economy as a whole. And there remain other negotiations that are going on, right? That's what it means to be in an economy where workers have some power, where unions are at the table, and we are monitoring the negotiations, but trust that the parties are going to do what they need to do.
Have you spoken to UPS? Have you spoken to the union involved this week?
Yeah, I've been in touch with both parties. I've also, just in my role as acting secretary, talked to parties to these negotiations, as well as unions and employers across the economy. And so, again, I'm hopeful and know that that they're going to continue to do what they need to do, and that a fair contract is something that that everybody hopes that there can be win-wins, as we saw at the port.
Secretary Su, I've heard that word thrown around quite a lot by this administration, this word fair. And language is important, it's meaningful. What would fair be?
Right. So this president has been very clear that fairness and equity is very important, and that we can build an economy that is fair and equitable, meaning from the bottom up and the middle out, right, where nobody gets left behind, where we invest in the middle class. Bidenomics is all about investing in America, and in particular industries like semiconductors and manufacturing and infrastructure, but also investing in American workers and also increasing competition to decrease prices. All of those things are part of what President Biden believes is fair, and what we believe this jobs report demonstrates that a strong and fair economy can be.
That's all great, but we have to define what it means. For UPS specifically, and this agreement they're going to try and strike with this union, what would a fair wage increase be? Can you put a number on it?
Well, I will say the same thing that I said when I was out at the ports talking to the parties. A fair contract is one that the members are going to ratify. So a fair contract is something that that workers choose at the end of the day. And again, that process is important for the parties to be able to negotiate, to be able to stay at the bargaining table, and to be able to resolve issues. And I do believe, and as has been shown time and time again, there are win-win solutions there.
Don't we have to be careful there, though, if we start saying things like fair is whatever the union wants?
Right. So, I mean, at the bargaining table, right, there's all kinds of issues that we have seen throughout history that when workers can bargain alongside employers who are committed to, employers who understand that the best investment they can make is an investment in their workers, there's all kinds of things that can happen when it comes to wages and working conditions and benefits. And those are the kinds of things we want for every American worker, right? We want stable work. We want a path to the middle class. We want security in retirement. We want health benefits. We want leave. Those are all things that the president has prioritized. And I think those are all elements of what it means to have a good job.
There are issues you're working on, Secretary Sue. I know that. Your nomination hasn't been progressing to take you from acting Secretary of Labour to Secretary of Labour. What's going on with that? Can you give us some information on the timeline you're hoping that this gets dealt with?
So the president has expressed great confidence in me. He's nominated me to serve as U.S. Labor Secretary. I am doing that job. The confirmation question is certainly one for the Senate, but I've also appreciated the broad support I've had from a number of senators, and we remain hopeful about confirmation. And meanwhile, I am here to do the job and do what the president asked, which is help him finish the job. And we're, again, seeing progress and continued growth, and we know we have more work to do, and I'm all in to help get that done.
Are you concerned it's holding up the department's agenda at all?
No, so the work of the department continues full steam. We are, we have enforcement work to do to ensure that every worker gets the wages that they're owed and comes home healthy and safe at the end of the day. We are laser focused on connecting employers who need workers to the good jobs that are being created in the economy, to working people who are looking for those jobs. So that's another big priority for us, and those are very important, and we will continue to do them, and I'm proud to lead the department in these efforts.
Secretary Sue, we're happy to catch up with you this morning following the payrolls report. Thanks for being with us. Julie Sue there, the acting U.S. Secretary of Labour down in Washington, D.C. Following the payrolls report from about an hour and 21 minutes ago, with us for a final thought, I'm pleased to say Victoria Fernandez, Michael Collins, still with us. Victoria, let's talk about this market and equities. Equities have absolutely ripped this year. And in fairness to those that have been optimistic about the labour market, including this administration, last year, if you'd asked us where unemployment would be, I'm not sure we'd say in and around 3.5% 12 months later, and here we are. At the start of the year, if you asked where equities would be, I'm not sure we'd say up 16% on the S&P, down to about 15, 14, whatever it is now. On the S&P 500, the Nasdaq up by close to something like 40% year to date. Victoria, what did we get so wrong and what has gone so right?
Yeah, it's an interesting observation, Jonathan, because I am one of those people, as you know, that was not as optimistic on this market. And we really thought that we would see a recession somewhere around the middle of the year. Now we look at that closer towards the end of the year, still thinking that there's these elements out there that should cause us to have a little bit of caution, whether it's money growth, whether it's inverted yield curve, the rate hikes that we've seen from central banks around the globe, all of these things. But we've had some elements come in to really support this economy. When we had the bank issues in March, we had the Fed step in and put a tremendous amount of liquidity into the market. We saw the TGA spending in the first half of the year. That was a tremendous boost to the economy as well with the liquidity component. We've had a consumer that I think has stayed stronger than what people anticipated. Another force for the economy to continue to do well. And I think you've had rates up until this last week, rates for most of this year have stayed somewhat contained. That again, or yields, I should say, not rates, but yields on treasuries contained. That's given a boost to the economy as well. I think what we've seen over the last week with yields moving higher, that 3.90 to 4% range we thought we'd be stuck in for a while, we sliced right through that this week, and we saw the market pull back. You look at gilts. Gilts yields are back up to where they were back at the end of last year, and you've seen that equity market pull back about 10%. Same thing with foods. So I think we need to look at some of the issues that are occurring that could pull the market back. But up until now, there has been quite a bit of support for the economy that I think most people thought would be on the downside by this point.
Mike, I want to give you the final word. I've got about 30 seconds left. The final word is yours, sir.
Yeah, similar thoughts, Jonathan. I think if the markets start pricing in more of a permanence to this higher level of rates, i.e. four-handle, intermediate-term 10-year Treasury yields, I think that has to put pressure on valuations of all assets, right? Last time rates were this high, equity multiples were lower. It's really tough to justify, I think, equity multiples, real estate valuations on other types of debt if rates stay at these levels.
Mike Collins, Victoria, to the two of you, thank you. Your trading diary up next.
is crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Here's the trending diary. The NATO summit kicking off on Tuesday. CPI data Wednesday. Jobless claims Thursday. Then on Friday, bank earnings begin. JP Morgan, Wells Fargo, Citi, all coming up. From New York, that is for me. Enjoy the weekend. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The top names in business are on Bloomberg.
For Indigo, this is a 500 planes order. That's the biggest order ever in terms of number of planes. It doesn't change the short-term perspective on ramping up the production.
All our aircraft deliveries are delayed. The supply chain that was really decimated during COVID.
It's a real challenge for all the OEMs at the moment, but we absolutely have to have those aircraft delivered on time.
Nobody covers business like Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
All right, 30 minutes into the U.S. trading day, Friday, July 7th. Here are the top market stories that we are following for you at this hour. It's a confusing jobs picture. So payroll number disappoints, wages rise, unemployment falls. You got something for everyone. We're going to get a big takeaway. And higher for longer. We speak to Bruce Richards, Marathon Asset Chairman and CEO, says the Fed funds rate will be at 5% this time next year. We're going to get his take on jobs, the Fed, and what he's buying on the cheap. And it's a bad week for bonds. 2-year yield hitting its highest level in 17 years. Yes, we're fading that a little bit. Stocks also mixed on the day. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. If you were to ask me for a really big takeaway from today, I don't know if I'd have one for you, and I don't think the market does either.
I think we need to widen the lens, Alex. I think we need to take all of the data in aggregate and figure out what we've really learned. I actually don't think the 2 years gone very kind of far this week in some ways. I think the week started on the 5th. It didn't start at the beginning of the week, so I don't think we've actually gone very far. What do we really know here? We know that the labour market is still strong. We know that maybe there is a slowdown taking place, but the pace of that slowdown looks fairly anemic. It is happening, but it's happening slowly, and wages are holding up. But we knew that already, didn't we?
Yeah, I also find what Cameron Kreis wrote about, and he was saying that it's a gray zone economic data, right? Like it's gray. It's not black and white. There's something for everyone, and then parsing that through is quite difficult.
Absolutely. You can pick your number. You can take a different approach, and the data will support you on that. But you aggregate it all together. You think about what we've had this week. Started the week with the ISM manufacturing. We've had ISM services. We've had claims. We've had the JOLTS number. We've had the ADP number. We've got the payroll number today. So what does that in totality, because remember the Fed likes us to look at the totality of the data, tell us about what is really happening? So our question of the day is this. What did the labour market teach us this week? Trying to figure that one out. Mike McKee, Edward Harrison. Mike, what did the labour market teach you this week?
That it is still strong, and that the Fed is probably going to be raising rates in July. I'd say that's almost a certainty now, and leaning that way for September, dependent on what we get for the July and August data, because we are sort of we've been thrown off by that ADP report yesterday. 206,000 is still a very strong number for job creation this far into a recovery, and with interest rates where they are from the Fed. So there's still a long way to go for them in terms of bringing down what they think might be inflation-causing wage gains out of this tight labor market. 3.6% unemployment, 4.4% annual raises for people. It's not all bad, because now we're finally seeing wage gains above inflation, but the Fed needs to do more, they think, and these numbers support that.
Ed, you write a lot about how we're looking at a recession at some point. Do these numbers, the numbers over the whole week, do they help frame that any better? Do they help make you nervous about the call?
No. Well, I should say yes, actually, in the sense that what we're at now, we're at the highest levels in terms of economic surprises to the upside that we've seen in quite some time. If you look at some of the numbers, it's almost vertical in terms of the surprise versus almost all positive surprises. And that's a mean reverting series. That's the problem, obviously. The real question is, about this specific data point. This specific data point, it is that gray zone, I think, that says it's about as good as it can get for the bond market. It's slightly lower than was anticipated, but it's still good enough to say that the market's going well. However, if you look at it from a macro lens, if you take the rolling average of these particular numbers, what you're seeing is the unemployment rate, the number of unemployed reaching a bottom in April, and it's actually ticked up both in May and in June, both in a 6-month and a 12-month rolling basis. That suggests that that 3.4 number is the lowest for this particular cycle.
Is this still full employment, Edward? Because that's part of the mandate for the Fed. Is this as close to full employment as we're going to get from a Fed point of view? Because if it's ticking that box, it definitely isn't still ticking the inflation box. So if it's got one box ticked but the other box is not ticked, presumably it has to do more to tick that box.
Right, yeah. So I think that what Mike was saying earlier about it seems like a lock for July is spot on. And then September, it looks likely that they're going to go in that direction. We're not slowing enough for the Fed to feel comfortable that given where inflation is, that they can stop the rate hike trend. So I think that you'll get 25 basis points. You'll get another 25. And then the question becomes, how long can they hold at that level given the weakening that I see already happening and likely will precipitate a second half recession?
I want to jump in there and follow up on what you're saying, Edward, because when you ask about full employment for the Fed over the last couple of years, it became not just full employment in terms of a number, but full employment for everybody, trying to reach down into the minority groups, into the less educated, and get everybody a job. And you look at what's happened in the last couple of months, and we just had a chart up a minute ago, and if we can go back to that, if you saw what happened today, since April, we've seen black unemployment rise to 6%. We've seen Hispanic unemployment rise while white unemployment continues to go down. The people at the lower end of the income scales, those with high school degrees or less than high school, are seeing their unemployment rate rise significantly. And a statistic that I found notable today, when you look at what's happened with black employment over the last 2 or 3 months, black employment is down significantly over the last couple of months, 374,000 jobs lost there. So what does the Fed do about that? That becomes an interesting question. If that was their reason for letting the economy run hot, are they losing all those gains?
Right, because it's not actually working out. And then you wind up have student loan issues as well. So you're going to start paying back your student loans in the beginning of the year also, and sort of how that's going to work out with the jobs picture. So I guess on the question, Guy, so Guy and I debate the question of the day sometimes at length early in our editorial meeting. And my question of the day was, is this higher for longer? And then also how long? Yeah. And when you wrap in sort of what Mike's talking about in the economic gray zone, does the longer really start to bite?
So maybe we're already in the longer phase. You get a take on this in just a second. My take on this, Ed, and you can criticize my take because I'm sure Alex will tell me it's wrong. My take is that we are already in the higher for longer phase. Edward, this is rear view mirror stuff. The labor market works with a lag. We're already into the higher for longer. If this was what the market was doing a few months ago, effectively we're already seeing the slowdown. Where are we in reality now in terms of where we are with the labor market versus where rates are? That's the conundrum that I'm trying to grapple with right now.
I think we're in the descent phase. That is that, the numbers that Mike McKee was talking about, that's going to bring a descent from those individuals on the FOMC that are concerned about whether, the labor market cracking, and particularly for members of the community that are most vulnerable, that, the people who get onto the income ladder last. And so I think that we're going to start to see descents. So we'll have a hike probably in July. Maybe we'll have one in September. But if we do, then we're going to have descents. And then the question becomes what does inflation do over the coming months that allows the Fed to either continue that high plateau or then to cut? Because once the labor market starts to deteriorate significantly, that's when the bond market will start pricing in more cuts that they've now taken away.
Really great conversation and wonderful setup, and does really illustrate that gray zone that we're kind of all living in now. Mike McKee, Edward Harrison, thank you both very much. So coming up, we're going to get more perspective on that question of the day, Guy's question of the day. What did the labor market teach us this week? Bruce Richards, Marathon Asset Management Chairman and CEO, coming up next. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From New York City, in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?